Now, if the pool of global goodwill is all too shallow on vaccine supply or climate change, it's just as well we're not facing a global financial crisis. Well, not yet, anyway. There are uneasy rumblings in the markets about a Chinese company called China Evergrande. It's a property development giant with debts of $305 billion. It's been struggling recently to service those liabilities. Shares have plunged, and there are fears that China might be about to witness its biggest ever corporate collapse. Our economics editor, Ben Chu, is at the wall with more.
Yes, Mark, what happens when the world's most indebted property company in the world's second largest economy goes bust? Well, we might be about to find out. China's Evergrande Group is big. It owns more than 1,300 projects in more than 280 cities across China. It also has more than $300 billion in debts. This coming weekend, it's due to repay some of that debt, and it's expected to be unable to do so, meaning the firm could be deemed to be in official default. Now, there's been talk about this possibly being a Lehman moment for the Chinese economy, a reference to the 2008 failure of the US investment bank Lehman Brothers, which sparked a US and global financial system collapse of unprecedented proportions. Now, among most analysts, the assumption is that that particular traumatic bit of history won't repeat itself, and that there will be a managed wind down of Evergrande by the Beijing authorities. Though the company's difficulties have already sparked protest among its worried ordinary creditors, losses are expected to be inflicted on mainly foreign lenders. Yet the rather scary thing is that the opaqueness of the deeply intertwined Chinese real estate and financial system means we can't be sure how smooth this restructuring process would be. The key point to bear in mind is that this is not just about one overstretched property company. The rest of the Chinese real estate sector is also highly indebted. The danger is if Chinese house prices crash, perhaps sparked by Evergrande property fire sales, there could be a domino effect of failures, which might be hard even for Xi Jinping and the deep-pocketed Beijing authorities to prevent. Now, the Chinese embassy in the UK told Newsnight tonight that the risks related to Evergrande are isolated and they will not create any significant impact on the credibility of the real estate sector. Yet a bigger question is whether China itself is a bubble economy inflated by a colossal expansion of cheap bank credit for property development. This chart shows measures of real estate-related activity as a share of GDP in different countries. And the importance of property in China now towers above others, accounting for just under a third of all activity. It's now even larger in proportion to the economy than it was in Spain before the major 2008 property crash there.
I think that we have to watch not so much the financial issues, but really how the economy adjusts to 29% of national income, marking time or basically going down.
Now, we spoke about Spain just now, and of course China is much larger and more important to the global economy than Spain was during the 2008 financial crisis. This chart shows annual world growth between 2015 and 2019, and China was responsible for a third of that growth. That's a much bigger proportion than from the US and other advanced economies like those in Europe. Chinese growth has sustained scores of countries around the world through its vast demand for raw materials and imports. A China property crash or even a significant China economy slowdown would have a significant negative impact on Western economies, including the UK, hitting exports, jobs and incomes. As with COVID, so with economics. When China sneezes, the world catches a cold.
It can't be contained in China because China is the world's biggest export market and the biggest trader in the world. It's the center of global supply chains. So it's hard to imagine that the world will not experience some sort of loss.
That's the reason financial markets, not only in Asia, but in the West too, have been unsettled by the crisis at Evergrande in recent weeks. And the reason why this weekend's due debt repayment by a Chinese property company matters to us all.
Ben, thank you very much. Let's discuss the ramifications of this situation now with Professor Ken Rogoff from Harvard University and Dr. Linda Yu, author and fellow in economics at Oxford University. Welcome to you both. Professor Rogoff, do you think that some kind of correction in the Chinese property sector is now inevitable?
Well, they certainly have to shift to a slower growth path. your correspondent, economics correspondent, did a great job laying out what the problem is. They really have real estate as their go-to policy for making the economy grow. That's what they did after 2008. So it's not just the prices are very high in what they call the first tier and second tier cities where everyone wants to live. Houses are empty in a lot of the third and fourth tier cities where a lot of the building goes on. And they need to reorient the economy, downshift to where housing and real estate is a smaller part of it. And that's not an easy adjustment to make. Are they going to have a price crash and an all-out financial crisis? I think they can slow that down a lot because they just have so many tools. But at the same time, they can't forever go on the way they've been going. And I think they recognize that. That's, in fact, part of why they're letting Evergrande go. They have trillions of dollars. They could bail it out, but they just don't see an end to this.
Dr. Yu, I mean, Ben also mentioned there is foreign banking exposure here. Is there a risk of a wider financial crisis if this company goes down?
I think of their 300 billion or so of debt, which is absolutely huge, about 18 billion is owned in foreign currencies, but that doesn't mean it's owned by foreigners. So in other words, some of this is owned by Chinese banks and other state-owned institutions. But that's not to say that when you have a potential crisis of confidence, that could have an impact, especially on economies which sell to China. So, for instance, say that China has manages this housing bubble slowdown, it would have a pretty significant economic impact, and that could dampen Chinese demand, and that would have effects on other economies that sell to China, including us, including Germany, including the United States. But because the Chinese real estate sector is mostly indebted to itself, as in to the Chinese banking system and to the Chinese financial system, the degree of financial contagion is probably less than an economy that was more open and took in more foreign credit than China.
Okay, so in that sense, that's a positive. Ken Rogoff, do you think the prestige of the leadership, Xi Jinping and the party, could be at stake here if they mismanage this contraction, this slimming down? Because it's thought that they want the property sector to shrink a bit, isn't it?
They do want the prices to go down and the construction sector to shrink at the same time, which are almost opposing things that they're trying to accomplish. I hesitate to say that the prestige will shrink. The confidence of President Xi and the leadership is astounding. I mean, this is one of a dozen balls he has in the air. He's cracking down on the tech titans. He's trying to stop people from home tutoring their children as much so that they'll have greater equality and outcomes. He's banning cryptocurrency. He's flying planes over Taiwan, launching a hypersonic missile. There's a lot of things going on. This is a piece of it. But I think we are going to see over the next decade really quite a slowdown in China's economy. And goodness, we're going to feel that. I think your correspondent Ben said it's accounted for a third of global growth in recent years. That's been going on for a long time. That's going to affect commodities, German car exporters, and you can go on and on. It's a big deal. Is it going to happen all at once? That would really be shocking if it did, but it's still very difficult, even if it's a slow burn.
Linda, you just picking up on that. I don't want to say if China catches a cold, that the rest of the world will get it as well. But it's clear the implications there. I mean, what are the sectors that you'd be looking at in Western economies that are slow down, or even something more serious in the Chinese property sector might herald difficulties for?
Well, I think there's both the direct and the indirect impact of a Chinese dramatic slowdown. So I would be looking at what happens to global commodity prices, so energy prices, something that we've obviously in this country been looking at for quite recently. But everything from raw materials, commodities, China's been the biggest source of demand for these. So in one sense, a Chinese slowdown would cause prices to fall there, and that may actually alleviate some near-term inflation.
Good news on energy. Yeah.
Well, but let me stress the larger impact would be China essentially no longer being a major source, an export market for the likes of Germany. I think Ken mentioned there the car sector, quite a lot of capital goods Germany sells to China that would be impacted. China is one of our top 10 trading partners, so we run a trade surplus in services sold to China, even though the overall position is in deficit. So it's going to have a wide-ranging impact on us, on other major economies, and actually really, I would say all economies, because China is an important market for many, a wide range of goods. So we can also think about luxury goods. You can think about tech goods. There are more iPhones sold in China than there are in the United States. So a slowdown in China would have widespread implications in terms of direct sales to China. But there will also be these other, as I say, kind of price effects around commodities. So on the whole, Mark, I don't think it'll be a net positive for any of us.
Absolutely. Linda, you, Ken Rogoff, thank you both indeed very much. Now, the front pages are coming in, so we can take a look at some of those. The Times, the Amos murder suspect targeted 2 other MPs. Now, they're talking about an allegation there against the person charged with that crime, that he basically conducted surveillance on other MPs' constituency offices and even of the Houses of Parliament. The Daily Telegraph, the boosted wait could be cut to 5 months. This is the consideration going on in the Joint Committee on Vaccination and Immunisation, of possibly cutting that from 6 to 5, I think particularly for those of us who've had the AstraZeneca jabs. The Financial Times, the rate rise debate is live, they say, because of the rise in the rate of inflation. They've also got a story about the US dropping tariff threats after reaching a digital tax agreement with Europe. That's over the tech giants. Right, Guardian, very quickly, GPs threaten industrial action in row with Minister. That's the lot, I'm afraid. Join us again tomorrow. Good night from all of us.